In just a matter of hours, it felt like the floor dropped out of the entire global market. Trillions of dollars just gone. Precious metals, the one thing everyone runs to for safety, they went through a crash that was so historic, it left everyone completely stunned. But here's the thing. This was not your average market correction. We're going to pull back the curtain and show you what really went down.
Get this. In a single day, silver absolutely cratered, plunging by 27%. A drop that big, that fast? It's pretty much unheard of.
And gold wasn't safe either. It dropped a massive 12%. I mean, this wasn't just a bad day on the trading floor. This was a shockwave that rattled the confidence of millions of investors all over the world.
But what if this wasn't just random market noise? What if this was actually a deliberate, calculated wealth transfer, perfectly hidden behind all the chaos? Well, in this explainer, we're going to follow the breadcrumbs and expose the forces that really orchestrated this whole thing.
So, how did this perfect storm even happen? Well, it wasn't just one single event. It was a deadly cocktail of different factors that all came together to create the perfect setup for a historic takedown.
There are really four key pieces to this puzzle. You've got a rising US dollar, some pretty aggressive signals from the Federal Reserve, slowing manufacturing numbers out of China, and to top it all off, a government shutdown in the US. Each one of these played a critical part in the meltdown that followed.
First up, let's talk about the US dollar index, or as the pros call it, the DXY. It basically measures how strong the dollar is compared to other big currencies. Now just think of the dollar and precious metals like they're on a seesaw. When the dollar goes up, it pushes the price of gold and silver down. And right before this crash, the dollar was getting seriously strong.
So, why was the dollar flexing its muscle so much? Well, the Federal Reserve started sending out what we call hawkish signals. Basically, they were telling everyone they planned to keep interest rates high. And high interest rates, they act like a giant magnet for foreign money. Investors from all over the world started chasing those better returns, flooding into US dollars and bonds. And that money had to come from somewhere. A lot of it came right out of gold and silver.
The third domino to fall hit silver especially hard. See, unlike gold, which is mostly just a monetary metal, silver is a crucial industrial metal. We're talking essential for EVs, for solar panels, for semiconductors. So when China came out with weak manufacturing data, it was a huge red flag. It signaled that industrial demand could be slowing down, and that sent investors scrambling to sell silver even faster than they were selling gold.
And the final nail in the coffin? A partial US government shutdown. Now you gotta remember, leading up to this, gold had already jumped 30%, and silver had gone on an absolute tear, up a whopping 65% in just a month. Traders were sitting on mountains of profit. The political chaos from the shutdown was the perfect excuse they needed to hit the sell button and lock in those massive gains. But, these four things, they're only half the story.
Okay, now we're getting to the real meat of it. The biggest, most hidden reason for this crash comes down to a powerful financial weapon designed to literally force traders out of their positions, the margin call squeeze.
All right, before we dive in, you have to understand this term. A margin requirement is just the amount of cash you have to put down to keep a leveraged trade open. So if the exchange suddenly jacks up that requirement, you've got two choices. Come up with more cash right now, or you're forced to sell your position, whether you want to or not.
And that is precisely what they did. The CME Group, the exchange that handles these futures contracts, raised the margin requirements for silver not just once, not twice, but 4 separate times in only 6 weeks. This put an insane amount of pressure on anyone who was long silver.
Here's the best way to think about it. Imagine your landlord decides to raise your rent 4 times in 6 weeks. It goes from 25 grand to 50, then to 75, then to 100 grand. Eventually, you just can't afford it anymore, and you're forced out onto the street. That's exactly what was happening to these traders. They were squeezed and squeezed until they had no choice but to liquidate, which just threw more gasoline on the fire.
So all this forced selling created this bizarre situation, a massive disconnect between the paper price you saw on the screen and what was actually happening with the physical metal in the real world.
It was truly a tale of two markets. In the paper market, on your computer screen, contracts were being dumped left and right, and the price was in an absolute freefall. But in the physical market, demand was going through the roof. Mints couldn't make coins fast enough. Dealers were completely sold out. Sales were being suspended. So how can the price be crashing when literally everyone is trying to buy the actual physical stuff?
And the proof was coming in from all over the world. The major government mints, we're talking Perth, the US Mint, the Royal Mint, all suspended sales. Dealers in India started defaulting. They just couldn't deliver the metal they'd promised. And get this, in one single day, 27 tons of silver were physically pulled out of the vaults in Shanghai. The paper price was being systematically crushed, while the real metal was being bought up at a furious pace.
So we've seen the mechanics of the takedown, but what happens next? Well, to get a clue, we've got to look back at history. A rally like the one we just saw has only really happened twice before in the last 50 years, which gives us two very different roadmaps for what could be coming.
Okay, so back in 1974, after a similar kind of crash, the silver market basically went nowhere for 5 years, just a long, boring period of stagnation. But in 1979, the crash was followed by this huge 40% pump, which turned out to be a classic bull trap, right before it crashed again even harder. So two very different potential outcomes.
And that, right there, is the million-dollar question for every investor today. Are we about to head into a long, drawn-out period of nothingness like in '74? Or are we about to see a sharp, nasty, deceptive rally like '79 just before the next leg down?
All right, so what in the world does all this mean for you and your money? Market this crazy, the worst thing you can do is panic. So let's talk about a rational, logical approach based on where you're at.
Look, if you own the actual physical metal, the advice is pretty simple. Just hold on. It's your long-term insurance policy, and you haven't actually lost a dime until you sell it. Now, if you're a leveraged trader, this is a massive wake-up call. It's time to cut down your position size to something you can actually afford to risk. And if you're a new investor, well, moments like this, when there's blood in the streets, that's often when the smartest money starts buying. The key, though, is to be patient.
A really smart strategy, especially for new folks, is called buying on dips or dollar cost averaging. Instead of trying to time the bottom and going all in at once, which is almost impossible, you can use ETFs to just buy small amounts in stages as the price falls. This lets you average out your entry price and seriously reduce your overall risk.
Let's wrap this up with a really crucial piece of wisdom. The market is basically a machine for transferring wealth from the emotional to the rational. Every single person who panic sells at the bottom is just handing a massive discount to the big institutions who are happily waiting to buy it up on the cheap. So the real question this whole crash leaves us with is this. In a world of paper promises versus physical reality, what do you actually own? And when the next crisis hits, are you going to be the one selling out of fear or the one buying with conviction?